All right. We are doing Lessee accounting on example 3 in the lecture note. If you are skipping around, I would suggest getting your lecture note and your calculator out. The last one, I kind of didn't complete E, which is a, just a little bitty journal entry, but I'm not really good at, splicing things together. So we're going to finish off number 3, and really this is number 4. So the journal entry to record the payment on the last example is just cash credit 15,000, and it all goes to lease liability. All right, it is as simple as that. So let me try one of these stampers. Bam, check it off. There you go. Check it off. Example 3 is done. I will just point out from the last one that we don't have interest payable to debit when we make the payment. It all goes to lease liability. All right, so really we're going on to example 4. Now, the big change here is guaranteed residual value greater than expected residual value. So in lessee accounting, we have to focus a little more on the residual values. With the lessor, they capitalize the present value of the lease payments plus any time the item was returned, the residual value guaranteed or not, the expected residual value. Well, with the lessee, first of all, if it's not guaranteed, they don't care about it because they're only going to present value the lease payments, and residual values are only included in lease payments when there's a guarantee in the GAAP definition of lease payments. So that's the first thing. The second thing is for the lessee, there's going to be a distinction between the guaranteed residual value and the expected residual value. Sometimes the guarantee and the expected are the same, and in that case, then they would expect not to pay anything, because if you guarantee a residual value of 5,000, but you expect the residual value to be 5,000 at the end, you don't expect to actually have a cash payment. And the principle here under GAAP is that the lessee will include any amounts of guaranteed residual value that are in excess of the expected residual value. All right, so in this example, let's walk through, see what's happening. Some of these tools I'm still getting to know, so wow, got the little hand grabbing the sheet. All right, there we go. That was a lot of fun. Awesome. Okay, so same lease, except we're going to tweak it a little bit. It's a 5-year non-cancelable lease. And let me get this little spotlight. The rent payment is $14,400 a year, $14,404 a year in advance. Does not transfer ownership, no bargain purchase option, and is not a specialized asset. So that's just the classification thing, right? We just have to make sure we're ticking the boxes. So none of these says that it's a finance lease, but we know that it's going to meet the present value test. Their incremental interest rate is 10%. The rate is not known, not a big deal. In fact, we are accounting guides, and we know that it is 10%. But in practice, they give us the fair value. If you have the payments and the fair value, then you can calculate the implicit rate. So, but it doesn't matter. All we have is the incremental interest rate. In your problems, if it says the implicit rate is not known, unless the problem asks you for the implicit rate, assume that it's what's called impracticable. That just means it's like really costly to calculate the implicit rate. And we're going to use the incremental interest rate. The guaranteed residual value is 4,000. However, Cougar expects the residual value at the end of the lease to be 3,000 instead of 4,000. So they guarantee the residual value for 4, but it's expected to be 3. Okay. The economic useful life is 8 years. So first of all, we're going to calculate the amount of lease liability capitalized. So we still have, as we did before, the lease payment, which is just the rent payment, times the present value of annuity factor due 10%. There's 5 payments. Now here, it's the guaranteed amount, the guaranteed residual value, minus the expected, E for expected residual value. Okay. So this is either going to be this or it's going to be 0 if expected. Oh my gosh, you totally can't read that. Let me move over here where I got some room. So it is kind of a confusing formula. So the residual value in, lease payments equals, so if the guaranteed residual value greater than expected residual value, then it's the guaranteed residual value minus the expected, which is our case here. Otherwise, zero. So those of you who did, took a lot of math classes, you might remember this. All right. So it's a discrete function, and over one space it has one equation, and over the other space it's zero. So all we're doing, but conceptually it's pretty clear. You only want to include in the capitalization the amount of cash that you expect to pay. You guarantee 4,000, but you expect the residual value to be 3, so you expect to pay 1,000. If the guarantee is 4, but you expected anything over 4, it would be 0. Okay? You present value all that mess, and you get 6684. Okay? And here you go. This is a vertical representation. So you have at time 0, time 1, 2, 3, 4, and 5. So you have 5 payments, and then payments plus guaranteed residual value greater than expected residual value. Okay? So this is what they mean by lease payments. So I'll just say this is GAAP. These are GAAP lease payments. All right, so figuring out your calculation, you have to figure out, hey, what are the cash flows that GAAP says to present value? In this case, it's the actual lease payment of 14,404. In addition, an annuity due of 5 payments, 10%. In addition, there's a lump sum of the guaranteed residual value minus the expected residual value of 1,000 at the end. You present value all these, and you get the capitalized amount of $60,684. Now, this schedule is a schedule for the lease liability, okay? So even though you're going to capitalize a right-of-use asset in the amount of $60,684, we're creating this schedule to amortize the lease liability and calculate interest expense, because every journal entry is going to be across these 3 columns. Your day 1 payment, you're going to have cash 14,404 credit, and you're going to debit the lease liability 14,404. Your adjusting entry on 12/31 will be interest expense 4628, and then on 1/1, when you make the payment, you'll credit cash 14,404, and you'll you'll debit lease liability. We'll see the journal entry in a second. Sorry, I'm flaking out. It's been a long day. I need a little cafecito, a little coffee. Okay, so, and this is effective interest method. So just to remind you, it's 10% times this gives you that. 10% times this gives you that. 10%. So just going down, All right. And then 46,280 less 9776 is 36,504. So that's your amortization of your lease liability, and it's based off of payment dates. So these are payment dates over here. Okay. So we're going to keep cruising, calculating the amortization expense. Once again, if you saw the prior example, it was a transfer of ownership, so it's amortized over 8 years, straight line. But this is item returned. Therefore, we use the 5-year lease term. You have to amortize it over 5 years, the right-of-use asset, because you're going to return the item in 5 years. So here we go. We're not going to do the interest expense journal entry, my bad. But we are going to do the entry to record the return of the Bobcat on December 31. So, and we're assuming that the expected residual value equals the actual. So we guaranteed 4,000, but we only got the expected of 3. So the first, excuse me, we guaranteed 4, but we got the expected of 3. So we predicted this. So here's our cash, and we reduced the lease liability. Done and done. So it's that simple. We got what we expected. Now, let's say the actual residual value was 1,500. So we expected 3,000, but when we got there at the end of year 5, it was, or at year 5, it was only 1,500. So we had to pay 1,000 and for the original shortfall that we anticipated, which is why we capitalized it. But then we got surprised by this extra 1,500. It wasn't worth 3,000; it was worth 1,500 less. So we have to pay actually the 1,000 plus the extra 1,500 that we didn't expect, 2,500. Well, the lease liability is still only going to be reduced by 1,000 to balance out. Let's look at the schedule. See, we have 1,000 right here, 91 in interest and 909 in lease liability balance. So we're not going to mess with that. It wouldn't make any sense. It's going to mess our schedule up. Instead, what we do is whenever we have negative surprises, we'll put them in loss. And this one's a loss on lease. Okay, so that's how to deal with guaranteed residual values in finance leases, both in the circumstance D here, D, where your expected residual value and actual is 3,000 or more. It could have been, if it was anything over 3,000, it'd be the same thing. You don't have gains with expected residual values, and with guaranteed residual values, the lessee is just taking all the downside. They don't get the upside. And in example E, we shook things up a little bit and say, hey, the actual residual value was 1,500, not the 3,000 you expected, and we see how we have to recognize the loss. All right. If it would have been 5,000, we wouldn't have recognized a gain because that goes to the lessor. All right. So hopefully some of that made sense. We're going to move on in the next video to example 5.